Put ratio spread. This strategy is where you buy an at-the-money put and sell two or more further out of the money puts below it. You use this trade when you expect the market to make a slight down move, but there is potential for the market to keep going higher or make a significant up move. The objective is to put this trade on as a credit, a free trader, very, very cheaply. If the trade is done as a credit, the profit is limited on the upside to the premium collected. In other words, if the option expires above your long put and it was done at a credit, that's your profit potential. The profit on the downside is limited to the difference between the long and the short legs. If the market expires above the long put, your risk is limited to any premium paid for the spread if you did it at a debit. Whenever you hold more short puts than long puts, the downside risk is unlimited below the short puts. Having unlimited risk, this trade needs to be watched closely. Here we're looking at doing a put ratio spread, a 1x2 put ratio spread in the March feeder cattle. I use this type of trade as a counter trend trade. As you can see, the market's been coming up and has recently broken into new highs. However, looking at a historic chart, the market is trading at or near all-time highs, and I feel that, well, there's a lot more potential to the downside than the upside. However, markets tend not to go quietly into that good night, and it's not going to just turn around on a dime and drop like a rock. So we do this 1x2 put spread. Now my game plan is if the market continues to go higher, I can do this type of trade too forever. I can keep rolling it up by doing another 1x2 on top of my long put, thus rolling this into a diamond put butterfly. Now, getting filled on this trade, we get filled and we actually get a $150 credit. That means if the market is above 112 come option expiration, we'll still make money even if the market's, we're wrong and the market continues to go higher. The risk on this trade is if the market drops and goes down too far. The risk level, we have what's known as a reverse break even on this trade. How you arrive at that reverse break even is you subtract 108 from 112 and you subtract the difference between the strike prices from the short put. And you come up with 104. Now 104, if anywhere in this market above 104, this trade will turn a profit. So we've got a pretty wide profit playground. In other words, if the market continues to go up, we can make money. If the market goes sideways at this level, we can make money. If the market goes down, but just doesn't go down too far, it doesn't go below 104, which, by the way, is 11 cents below where the market just closed. So the market would have to go down 11 cents for us to lose any money out of pocket. This is almost a perfect trade. It removes much of the risk of trading out of the market, but not completely. Keep that in mind. Our profit potential is limited to the distance between 112 and 108, or 4 cents, which in feeder cattle is $2,000. Now, some of the bad characteristics of this trade is, let's say it does drop on a dime and starts to go straight down. We're long one put, short two puts. And the two puts will be losing as much as the short put will be making. And in some cases, they'll be losing more. However, intrinsically, with no time value that is, the market would have to be below 104 for us to lose money on this trade out of pocket. Anything above 104, hey, we make money. And we make the most money at 108. However, it will return a profit anywhere from 104 all the way up to infinity. 28 days later, as the market's going sideways, we're in a perfectly balanced trade. The loss in the 112 is being offset by the gains we're making on the short 108s. 28 days later, the market's starting to head down lower, yet we're still not making any money because the losses in the gain in the 112 is being offset now in this case by the loss on the 108. 28 days later, now you can see us starting to make some money. Now keep in mind, we're short two puts, long one. The extrinsic value in the short two puts is holding us back. We want this trade to run out of time. Again, we need to remind you that there is a substantial risk of loss in trading currencies, futures, and options, and past performance is not indicative of future results.